You made a profit. That's great. Now watch the IRS take a huge chunk of it because you fell into one of these 5 common traps. Most investors focus only on making money, but the wealthy focus on keeping it. Today, we break down the 5 biggest tax traps, from the wash sale rule that silently wipes out your losses to the deadline mistake that costs you thousands. Trap number 3 is the one that destroys most beginner trading profits. Welcome back to Judas. Tax efficiency isn't just for billionaires. It's the fastest way to accelerate your portfolio growth. These 5 traps are legal, easy to fall into, and can turn a profitable year into a painful one. Let's start with trap number 1, the wash sale disaster. This is a trap designed to stop you from benefiting from tax loss harvesting. Here's how it works. If you sell an asset, like a stock or crypto, at a loss, but then buy the same or a substantially similar asset back within 30 days, the IRS disallows your loss. You pay the tax, but your loss benefit is wiped out. For traders, this is common when trying to quickly re-enter a trade. The fix: wait 31 days to re-enter, or buy a slightly different asset class instead. Short-term capital gains profits on assets held for under 1 year are taxed at your high ordinary income rate, which can be up to 37%. Long-term gains assets held for over 1 year are taxed at a much lower preferential rate, 0%, 15%, or 20%. The trap is taking profits too soon. The fix: have 2 distinct portfolios, a short-term trading account and a long-term investment account. Be extremely disciplined about only selling assets from the long-term portfolio after the 366-day mark. This is the profit killer. When you trade, you must track your cost basis, the original price paid for the asset plus any fees. The trap is simply using the first in, first out FIFO method automatically. If you bought Bitcoin at 10K, then at 20K, and sold some later, FIFO assumes you sold the 10K coin first, which inflates your profit and tax bill. The fix: use the specific share identification method if your broker allows it. You can choose to sell the asset you bought at the highest price first to minimize your taxable gains. This isn't about the April tax filing. This is about contribution deadlines for your 401k and IRA. The trap is missing the deadline to contribute to the previous tax year. Contributions made before the April deadline can count for the prior year, giving you a massive tax break. The fix: treat January through April 15th as a second chance to max out last year's tax-advantaged accounts. This is pure, free tax reduction you are voluntarily giving up. Many people transfer assets between family members or between accounts, thinking it's a non-event. The trap: transferring a highly appreciated asset to an heir before you pass away often transfers your low-cost basis to them, meaning they pay huge taxes when they sell. The secondary trap: selling assets to rebalance your portfolio creates a taxable event you weren't planning for. The fix: talk to an advisor about the step-up in basis rule for heirs, and always be aware that selling yishkor a taxable event. Tax traps are everywhere, but knowing them is half the battle. Trap number 3, ignoring cost basis, is the one you need to check with your broker immediately. If you're serious about mastering the markets, the first step is knowing the rules. Now, if you haven't seen our last video on the 5 investing moves rich people are making right now, click on the link on your screen now to see the strategies that will build your wealth and get you ahead. Subscribe for more deep dive strategy.